Hey, welcome to the October meeting of Transaction Review and Calculator Practice. Dimitri, great to see you. Ken, I always love it when you're on board. Can you guys hear me all right?
I
Yeah,
can hear
hi.
you. This is Ken.
Hi, this is Dmitry.
Hi, Dimitri, Ken, great. Kristen, Susan, I don't know if you guys have a mic, but welcome. It's always great. I've been missing you guys, and we need to talk. So we'll talk probably tomorrow sometime if we can get our schedules to coordinate. Anyway, I spent the last 5 days in Tucson at at a business builder event by a guy who used to be really heavy hitter as an REO broker. And so he's really steeped in the whole traditional realtor mindset. And now that business is drying up for them. You know, guys who had 300 to 500 listings a year maybe now have 5 to 10. So the wonderful thing is he's transitioned his whole model to owner financing and creative strategies. And so I was really pleased to be a part of that event. And then to get to meet so many realtors, it's like finally you got realtors that are ready to listen, to some of these things. So it's super exciting. And I'm just catching my breath from coming back in town today. But this is something that I just thought I would recap certain ideas. I kind of recycle through these transaction reviews, and hopefully if you already get this, you won't mind that we're going over this again. But it's a real live deal. That this is this is a guy that I've bought a partial from. I've bought a couple partials from him, and now he came to me and he's selling an apartment building that he owns. I can't remember how many units. I want to say 10 or 11 units. Free and clear, he owns them, and he wants $100,000 more cash at closing than the buyer has for a down payment. The buyer has a $250,000 down payment, which is really great, right? 50% down is very solid, but they either can't or don't want to get bank financing on this. So the note balance is $250,000, and I'm going to pull this thing up too. And the interest rate is 6%. Now, I said to this guy, why, he's emailing me of what can I do? Oops, where'd that come from? What can I do with his note? And I go, why don't you come to me before you ink the deal? Because then I can maximize, the amount of money he can get for his note. But that's not the way he decided to do it. They already made this agreement. So we've got a $250,000 note. And that goes in principal value or present value here, or this could be considered loan amount, right? The present value of the loan today is $250,000, interest rate 6%, and it's higher than the bank would give, I would guess, but not bad. That's really low for private financing. And it's amortized over 20 years. So that's kind of long. And you guys know that have been hanging around that, these anything longer than basically 10 years, 12 years, the future value of those payments to be received are really small. Like I won't pay much for a payment that's not going to come in for 15, 20, 30 years from now. So his monthly payment is this $1791.08. So that's how we get basically what that note was. And so he wants to net, and I'm not figuring closing costs here just to keep it simple, but he wants to net $350,000 at closing, and he can only get $250,000 from the down payment. And then if I bought the whole note, for me, if I'm hanging out for 20 years, I'm trying to get, and there may be people that feel differently, but I'm going to throw this in at a 14% yield, because if interest rates go up, which a lot of people think they're going to go up at least a point in the next 12 months or something, I want to make sure that I stay well ahead. I have quite a spread above prime or what I could get if I was investing in an annuity or a mutual fund or a CD at the bank, right? So that's a long time to hang out. Even though this is super safe, I'm still going to throw 14 in there. Maybe I should throw higher. I don't know. Some people will take less and some people would want more. So if I want a 14% yield here, I left everything else the same. And now I'm just going to press PV, present value, to see how much I would pay for that note. And it came out to 144,000, which, if he takes the 250 plus the 144, he'll get almost $400,000 for his $500,000 building. But he doesn't like that, right? He wants 500,000 or more. So he says, "Well, what can we do?" So I said, "How about I buy half of it? What? How about, that's a big discount. What is that? It's not quite 50 cents on the dollar. It's probably 60 cents on the dollar, something like that. So how about, what could I pay for 120? So let me put back in everything the way it was. Here's 6% in here to get back to our 250. Okay, so 120. I'm going to do that there. And then I'm going to put the 14 back in here. I don't know if I needed to do all that, but what will I pay for just half the note? Well, I'll pay 115 for the next 10 payments based on that's a 14% yield. And frankly, I'd really rather do this. I'd rather only be hanging out for 10 years than 20. And especially there's no balloon. I kind of wonder why he didn't put a balloon in this thing, but maybe the only way he could get his price of 500,000 was to offer really good terms. Maybe the buyer said, "Hey, well, if you're going to want a balloon, then I'm only going to pay 450 for the property." You know what I mean? So there's this balance between what will the buyer do, what will they agree to, and so if he's only getting 500,000 because he's giving these long and attractive terms, then I guess that makes sense for him. So how do we figure out what he'd have left? So I'm going to go back and recreate the note again, $250,000. All I know from this calculation is that I'll pay 115 for 10 years worth of payments. Let's recreate the note again here, 240. And I always just click that again just to make sure that all the decimal points are hidden behind the computer there. So I'll put in 20. After 120 payments have been made, I'm going to go over here and click future value. His remaining balance, when he gets the note back, will still be 161. So he's only giving up, what, $90,000 of the principal in order to get $115,000 now. So if he takes 115 now, and he still has a remaining balance of 161, he can look at it like he's getting $276,000 for his $250,000 note. So he's got 276, he's got his down payment of 250. It makes it look, at least on paper, when you're not considering the future, the time value of money, which most people don't really think about that very much. You can see that we're at 526. So that looks a lot better than 394 to this guy, right? He's trying to minimize the loss to his paper asset, which I can appreciate, right? We can all get that. All right. So what could I do? And what could you do if you were in my shoes? And feel free to type some things in. And if you want to talk, I'll try to unmute you and see if the line's good. But I've got it under contract at 115,000 at my 14% yield. What if I could find someone who, if I could just broker it and I'll just get out of the way, someone would be happy with an 11% yield, and hopefully their self-directed IRA or Roth or 401k, something like that, then they would pay probably 130,000 for that. They're still at a very low investment to value. That's a good, strong yield. There's always a remote chance that it could pay off early if he sells the property or decides to refinance for some reason. So in that case, I would pocket $15,000. Or I could bring in an investing partner, a joint venture, who could bring in the purchase price of 115. Let's bring the calculator back up. So just to show this part, remember how I decided if I need a 14% yield? Let me bring this back to 0, okay? That I'll pay 115, right? So let me put in, this is how I figured out what someone else would pay. 11%, and I'll click this here, and they'll pay 130. So I know I've got a $15,000 spread in there if I wanted to just, move it through, pass it through like a commission or a wholesale deal or something. But if I bring in someone for 115 and I don't, try to take any money off the table there, I'm going to say, well, if they put in 115 and they need an 11% yield for the 120 payments, the 10 years, how much of the payment will they need every month? Well, they're going to need, I guess I would pay less if I'm managing the note and staying in the deal. That's usually how I do that. I'm usually paying these days 8 and 9% with completely passive money. Someone who just really doesn't want to deal with it. They just want their, bank account money. And then if somebody's willing to handle their own note, it's more in the 10, 11, sometimes 12% yield. If I think it's safe for them anyway. Higher yield if they're experienced, then they want more risk sometimes. So anyway, so for them to get a 9% yield on their 115, they only need 1456, but I've got 1791 coming in. So then 1791 minus what I owe my investor, my joint venture partner on this, so that leaves $334 a month for me as passive income. That's my payment. Instead of $15,000 now, I'm going to take $334 a month for the next, if this pays as agreed or as expected, for 120 months. So what do I get? I don't get anything up front, but I get $334 for 10 years. And so I've made $40,000 over the next 10 years. Instead of, I could take $15,000 now, or I could take $40,000 for the next 10 years. And hopefully I'll buy the rest of that note from the guy. He'll invariably, it's very common. Once you buy a partial, someone decides they want to sell the rest of it, and they'll come back to you. You're pretty much the only game in town at that point, because it's very uncommon for another investor to buy a partial behind me, because I'm the one controlling the note. And most people don't like that. Okay, so then this is one of the things that I presented, for these realtors, because it's kind of hard for them to go, well, how come a $250,000 note isn't just like, what's the discount on the note? And it's like, well, let's think about this. We saw, when at the way that he wrote it, it was worth 144. For the full sale, right? 6% interest rate, amortized over 240. We got the note there, and if I'm plugging in my 14% yield, what will I pay? 144. Okay, so now what if the only thing I changed was the term, just how fast the money comes back? So I'm going to change, that's the only thing I'm going to change right here. Okay, so 120. Now let's see how much I'll pay. Oops, that's not right. Wait, what happened? Oops, I didn't mean that part. Oh, I know what I did wrong. 120, 250, 6%. Okay, now the monthly payment is $27.75. So that's a much quicker return of capital, right? The other one was 17. So this is about $1,000 more per month to fully amortize the loan in 10 years instead of 20. So now if I plug in my 14% yield here, then I'll pay 178. So that's like $34,000 more. This is not right. The 50% USB, kind of made a mistake on that slide, I see. How about another idea? What if, here's the regular note that he had there. What if we go back to the 250 there, 6%, or I'm sorry, the only thing we change is the interest rate. So instead of 6% interest rate, we'll put in a 9, and we'll still leave it as a 20. And I'm not sure that someone who's looking for cash flow would pay 9%, but this is just sort of an example of how differently a note can be valued. So now his monthly payment would be $22.49. I plug in my 14%. Okay, what would I pay? 180, 181, right? So that's pretty close. The other one, just cutting the amortization in half, is pretty similar in raising the interest rate. All right. And so what if we do both of those things? What if we put in 250 and the interest rate was 9 and the amortization was 120? That gives a monthly payment of $31.66. Plug in my 14% desired yield, press that, and voila, I can pay about $204,000, which is, wow, quite a bit more. Is that $70,000 more? 60 or $70,000 more than the way he's written it now. That's a pretty small discount overall. Only an 18% discount. This number here represents 82% of the UPB, the unpaid principal balance, which if I buy it at closing or one payment after closing, so this number, what I'll pay divided by the balance on the note, is how I get that number, the 82%, right? So then what's left going to 100 is 18% discount. Okay, then what if the only thing that we did different, we'll give him back his original note just the way he made it. 6 and 240. But the only thing is he put in a 3-year balloon. And because this is an investor property, it's not subject to Dodd-Frank and all those restrictions that are involved with residential properties, homeowners. So it's nothing, we don't have to worry about a short-term balloon at all. I don't know if it seems to me they'd be successful in refinancing if they had to, because they've got so much equity in it, and I'm hoping the property cash flows well. So if he would just put in, how do I figure out what the balloon would be in 3 years? Okay, now that we've put in this note, I'm going to put in 36 here. So that's how many payments have already come in. And after that point, how much do we have left? The future value. So the future value would be 228.7. So if I get 36 of these payments, and at the end of 36 I get this, now let's plug in my 14%. Look at that. That's really close to the same price I could pay if it was a 9% interest rate with a 10-year amortization. That's pretty interesting, isn't it? So that's how come balloons can be so powerful at preserving the present value of a note and minimize the discount. See, it's really almost the same, only a 19% discount. 203 divided by 250 is like 81% of the UPB. So the only issue here is it likely that this guy can refinance at that time? Does he have financial resources? Is it likely that the lending climate will be favorable for people to be able to refinance? Or looking at it, some people say, hey, well, I hope he can't, because I want this property for myself at 50 cents on the dollar or whatever, right? So that's the different thinking that's going on in the note market. And just for kicks and giggles, because, a lot of realtors and people who don't understand the note business, they think in terms of what banks would do. So what if this guy I'm going to give like maybe banks wouldn't even do this. Maybe on commercial properties, they'd only go out 20 years. But a lot of people will write notes like this. It's very common. Well, my tenant asked me to carry, and so I looked at what the banks are doing and, all of that, which is fine if that's what's helping you get the price. If they say, hey, I want this price and these terms, or I'm walking, and you're desperate, you're going to take it, right? To get your price. Otherwise, you have to drop your price to someone who can pay more cash or get a loan or whatever. So let's just see what happens to the value. We got to bring 0 to future value over here because this is a fully amortizing loan. So this is a very common bank-looking type loan. 30 years, 4%. Now if I need my 14% yield, ouch. Now I can only pay $100,000, $101,000 for this note, right? That is 40% of the UPB, unpaid principal balance, right? 100 divided by 250 is 40. So that's a 60% discount. Maybe, maybe for the safety, I could easily go 50% on this and I'll take less of a yield. What would that be? What would 50 be? 125. And just ride the fact that it's a super safe investment and the likelihood of it paying off earlier is good. So I might, I don't know, maybe. It just really super depends, but not so much. But anyway, you can see how profound it is. So the more money sooner is better. So you can see that the guy gets the most money with a balloon or shortening the term and raising the interest rate. So, but really, in his mind, right, he gets most money when where's that original slide? When he'll take his 250 down, he takes 115,000 for a partial. Partials are a fabulous, fabulous tool. He still keeps a big chunk of his note, and ultimately he can see in his numbers here that if he hangs out and leaves some of his equity on the table, that overall he can get a lot more for his real asset, the price he got on this apartment building, and his paper asset. So anyway, is there any questions? Let me try to unmute anybody. If not, that's kind of all I got for now. Just one of these examples that at least for this realtor crowd, they were kind of like, when I got to that 4% 30-year AM and the 100,000 came up, they all like gasped, and they just couldn't believe how much of a difference the value of a note can, the terms, determine how much the value of the note is. But wow, do you offend people when you give them a price for 50 cents on the dollar? It's really tough to get them to understand that. So, well, anyway, thank you so much for being here with me. I'll catch you next time, and hope you're all doing well. You have a great night.